Hello and welcome to Big Deal. I'm Nisha Poddar. Now, there are many factors which are impacting the startup ecosystem currently. Expensive funds, lower valuations, and also focus on the concept of profitability and that thrust by the investors. So, fundraising this year has been lower compared to the same period last year. How are we really poised for the next few months to come in terms of the new trends emerging in this particular space? Let's find out from two experts and investors joining me on Big Deal today. Let me welcome them on the show, Gopal, Jain of Gaja Capital and Sasha Mirchandani of K Capital. Gentlemen, welcome to CNBC-TV18. Now, Sasha, before I discuss this entire startup ecosystem and the investment sentiment there, I want to first congratulate you for the latest fundraise that you've done of over 750 crore rupees. Tell us more about this fundraising and the focus for this particular fund. Where are you going to deploy the funds? Because those companies will be making notes and lining up at your office now.
First of all, thank you and thanks for the invite to your show, Nisha. We've closed a 767 crore fund, approximately $100 million. We were lucky that a whole bunch of our existing LPs, most of them came back in. And we also got some new investors as well, which was a great, nice mix to have for the fund. The fundraise went surprisingly smoothly, considering the market environment. But I guess we've been around for 10 years plus, and that helped us a lot with our existing investors. And we're lucky to have the money now in this market. The focus, Nisha, we're a sector-agnostic fund. But what we're seeing, trends lines are in sectors like SaaS, vertical SaaS, dev tools, etc. We're looking at SMB tech. We did an investment recently for a company called Traddle along those lines. We're looking at fintech, lots of opportunities in fintech, and also lots of D2C opportunities. We've already made two investments, a company called Traddle and Foxtail from this fund. Both are direct-to-consumer brands, and they've both gotten off to great starts.
That's right. And also, Sasha, I want to understand, since you were on the road right now while the environment was worsening, while various factors and macro environment changes were taking place and the valuations were dropping for the startup ecosystem across the world, what was the kind of feedback that you were getting from your investors? And were they worried? Was it difficult to raise funds? And on the other hand, what are the key worries from their end?
They're clearly worried because if you see global markets, tech has crashed. And then you look at India, tech has crashed as well. Because last year there was so much euphoria, there was so much money being put into tech companies at the top of the market. And a lot of these people are also investing in these companies directly. And therefore, now their $1 is worth 50 cents or whatever. So there was obviously a sense of worry, but most of these people are sophisticated investors. In fact, it's pretty much all our investors are sophisticated. They know we're investing for the long term. They believe in India as a country, and that's why they came after us. So I believe that, yes, there were some concern areas, all valid, but I believe that this is the right time to invest, and we convince them that this is a good time, this vintage. In venture capital, the vintage is when you invest is the most important. And we believe this vintage of 2022 and even in 2023 will be a perfect vintage for us. And we managed to convince them of the same. And we were lucky to get the capital accordingly.
All right, good to have. You are in a good position to have cash at this point when so many could be really lining up. So, Gopal, welcome to the discussion. Give me your sense on the investor mindset currently. What's happening on the ground and what are the key pressure points?
Well, first of all, congratulations, Sasha. It's a fundraise, a successful fundraise and in a tough environment. So well done.
Thank you, sir.
And both for you and for the industry. Nisha, this is a time in which price discoveries become difficult for investors because both the economic and the financing outlook for the economy in whole and technology as well has worsened over the last 12 months. This is particularly true in the global context. I think in the Indian context, we are it's a slightly different picture. So let's start with the global context. Economies have slowed down. Many economies have confirmed that they are staring at a recession next year. And within technology as well, we've moved from a COVID mode of existence to a more normal mode of existence. In the US, at its peak, e-commerce penetration had risen to 16.5%. It's down to 14.5%. So technology, which within the economy was growing and growing only in one direction, is also reverting to the mean. Which is why I'm saying that for technology as well, the economic outlook has become a little less positive than what it was some time back. In India, our asset prices are still strong because the economy is strong. But any investor which is plugged in the global economy is feeling nervous right now. So
Yes.
people are expecting valuations, lower valuations, but many companies are holding back. Those who have capital are holding back. Some people are confused. Is this a passing shower, or is this climate change? And as a result of which, you have seen that funding activity has significantly declined.
That's right, Gopal, but I want to understand from you, how do you see the valuation mismatch going further? Because some of the companies which raised funds some time back are going to run out of cash. They will have to come to the market again. And there will be a requirement of some sort of a solution, either a fundraise or an IPO, which looks like a less positive, proposition at the moment for the startup ecosystem. So how do you see the valuation mismatch? Is that the biggest challenge currently? And what are those nuances that you are highlighting at the moment when anybody comes to you for investments?
So, I do see things change over the next 6 to 12 months. I think as people become more and more resigned or start accepting that this is a new normal, first of all, while technology will grow, technology will not grow in a near vertical fashion. Secondly, capital is no longer cheap, and capital may not become as cheap as it was a couple of years ago. It may take a long time for capital to become as cheap. And in a world where capital has some value, profitability becomes important. So I think there is still a very strong market for A-list companies. And I think A-list companies need not think about timing. There's a substantial amount of dry powder within the venture capital, private equity ecosystem. Investors like us continue to look for A-list companies and are still prepared to pay for growth. Technology is real. There's no doubt about that. The only question is the trajectory. And secondly, the trajectory of companies. Earlier, there were some companies that were not thinking of profitability at all. There's some companies that were thinking of profitability in 3 to 5 years. But in an environment where capital has value, profitability needs to become a nearer term pursuit.
That's right. Path to profitability and having the concept of profitability is very important, and that I hope is getting incorporated. But Sasha, at your stage, where the stage at which you invest, what are the conversations? Is the venture capital community feeling the heat already?
There are two parts to the answer, Nisha. In the part that we play, which is the first check, and seed and let's say early Series A, there's only been a marginal correction of valuations, not dramatic as I was hoping. But what's happened to our advantage is that we're getting more time for diligence. That helps a lot versus a situation where we have to take decisions in 2 or 3 days. And therefore, last year, we pretty much stayed out of the market. We only made a few investments because we're not comfortable making investment decisions in 2 or 3 days. Whether that's right or wrong, I don't know, but for us, it was wrong. However, as Gopal already said, in the growth stages, things have definitely slowed down. There's more time for diligence as well there. Valuations have come down to sensible levels. And what's happening is the flight to quality. The best companies are still raising capital. We are soon to announce one more fundraise for a large fundraise of one of our companies. And we had 5 or 6 term sheets for that company because it was almost profitable and growing in the right direction. And like I say, revenue is vanity, profit is sanity, but cash is king. And cash is taking center stage, Nisha.
Right, cash is definitely taking center stage, and it is also becoming more expensive, Sasha, in the current environment. So valuation-wise, how are you seeing the dynamics at a very early stage for a company? Because it is very difficult to value companies at that level when you're betting on new entrepreneurs. So what are the new aspects being incorporated in eligibility criteria in a much more tougher environment for assessing and betting your money there?
For what we do, it's pretty much the same because we're coming in so early. We can't talk to the entrepreneur, ask him or her for a profit plan. We're coming in first check. But what we're seeing is in our own portfolio as the companies progress and they raise larger rounds of capital, 10, 20, 30, 50, $100 million, that's when they need to be, in front of investors with a proper plan of profitability, is what I'm saying. And that's very important. You don't have to be profitable, but you've got to have a path to profitability. And a lot of the entrepreneurs in our portfolio have understood that. Not only have they raised the capital, but I see them raising capital even in 2023 in a tough market because they've made those changes in their businesses. It's not easy, right? Because last year we were asking these entrepreneurs to grow, hyper growth. And now we're telling them to slow down and move to profitability on a dime. Not so simple, but the best founders realize that they got to be flexible. And that's the trait we like, right? We believe founders who are flexible, open-minded, and persistent, especially in these environments, and are willing to take hard decisions. Entrepreneurship is hard, as every founder listening to this will agree. And the founders willing to take hard decisions are the ones that are the most backable in this environment.
That's right. And Sasha, definitely the concept of profitability and path to profitability is now coming in. That's a big change, even at an early stage, as you mentioned. So that's a very, very big change in the overall startup ecosystem, while a lot of companies earlier used to not talk about that or at least evade that particular question, even when they entered the public market. So that's a big change. But we will talk about the exit opportunities and making profits and returns out of the investments. What are the options left there, and what are the key challenges and trends that are emerging in the startup ecosystem going forward? Stay tuned to Big Deal. Welcome back. You're watching Big Deal, and we are discussing the entire startup ecosystem and the investment and fundraising environment at the moment, and what are the trends that are really emerging because of this tough period. Gopal, we were really discussing the investment thesis, the valuation dynamics, but the real return aspect, or the real investors' view, is on the returns from their investments. How are the exit options and opportunities coming along? And is that one of the biggest stress points for private equity and investor community right now?
Well, IPOs are the show horse, but M&A is the workhorse of the industry. And even in India now, M&A markets are 3 times the size of IPO markets. So what has really made the Indian venture capital private equity story more real is the emergence of Indian M&A markets. And I expect M&A to definitely pick up. As far as IPOs are concerned, yes. I mean, if you look at Indian public markets, Indian public markets have over 400 unicorns. 95% or more of them are profitable, probably 100%. And if you look at Indian private markets, we have about 100 unicorns. I would say 95% of them are unprofitable. So I think in the near term, at least, it's going to be difficult for unprofitable venture capital, private equity-backed companies to think of IPO markets as a route towards liquidity or exit. They'll have to stay private for longer. And this means, and there is mercifully a ton of capital still waiting to be invested in venture capital and private equity. I do expect interest from large private equity venture capital firms for M&A to return. I do expect interest from strategic investors to return. So I think there'll be probably in the short term greater reliance on private equity, venture capital, and M&A markets.
Right. But Gopal, I want to understand, for any of the M&A to happen, there has to be a consensus built on valuations. When is that going to happen in your view from now?
Well, it's only a matter of time. I don't think you can expect. It's difficult for people, especially given the dramatic nature of change. I think A, the change has been very sudden, and B, it has been in scale very dramatic. My sense is that A-list companies, have the luxury of time, but A-list companies don't really spend a lot of time thinking about timing. Eventually, it all works out. Probably, yes, in 2022, there has been this impression that there's some sort of a logjam in the markets. Deals are not getting cleared. There is no convergence. I'm hopeful that in 2023, the deal volumes will pick up.
Is that your view as well, Sasha? And how do you see exit options develop? And your overall view on consolidation, do you think that is likely to pick up in this space?
I agree with Gopal. Apologies. I believe that in our best companies, they're actively looking to buy assets. In fact, we start some board meetings with updates on exits. On M&A. But nobody wants to sell in tough markets because you obviously get less of a price. So everyone's going to play a dog and pony show. Everyone's going to waiting. But as time passes and the market continues to remain relatively tough, the weaker companies will have no choice, and therefore the companies that are well run, A companies, as Gopal said, they just have to be patient. They have enough capital. They're executing really well. Whether it be 3 months from now, 6 months from now, lots more M&A will come up, especially when new rounds of capital come up next year and founders realize they can't raise capital. So they rather than sell and move on. So you'll see lots more M&A happen next year, in my opinion. We are getting lots of opportunities to sell up our companies and our best companies. We have at least 5 companies where private equity / large growth funds are after us to buy our positions. But we are in no way going to sell them because we believe in those companies and we're holding on. But the good news is if we had to sell, you could sell even tomorrow morning.
Okay, so right now, good companies still have that backing from the investors. But Gopal, help me understand, with the recent, few trends emerging, like big layoffs happening in global and Indian companies in startup space, also the corporate governance issue coming to the fore. What is the kind of sense and the challenges and risk factors that you're anticipating that are really coming up as trends going forward?
Well, there are 2 parts of this question. One is, expense management, and the other is governance. I think in general, yes, there is an expense management challenge as far as technology is concerned. And this challenge has come to the fore because people were expecting much higher growth and people were expecting capital to remain cheap for a long period of time. So over the last 2 or 3 years, technology companies have built up expenses far ahead of demand. And generally, there's this impression now that technology has an expense management side issue. I'm sure good companies will correct in a good way. In India, I think we always generally refrain from layoffs. We are better at cutting salaries than cutting headcount. But my sense is that smart companies will get around to this. Governance is an entirely different issue. Last 3 or 4 years, the pace of value creation has been such that everybody felt that nobody really needed to come to work, whether it is investors or companies, right? People were working from home and investors thought that coming to board meetings wasn't important. I think this belief, this was a short-term belief, this recent belief that companies can deliver without corporate governance is misplaced. We've seen that from some of the recent disasters. I won't name them, but we've had Lehman-like crisis. We've had large investors invest in companies throwing caution to the wind. So it's going to be, again, going back to an old-fashioned way of running businesses. Adult supervision. Entrepreneurs need adult supervision. The rule of law is important, both in the public and private sector. And within companies, the rule of law is important. And how is the rule of law established? Through effective boardroom management and through investors playing a proactive role. So we'll be back to basics in the venture capital and private equity industry.
So for that, the investors will play a very critical role. And Sasha, from your standpoint, entering a company at a very early stage, mentoring the company, grooming the company, how are you seeing this trend emerging? Are entrepreneurs really, taking this idea well, and are they able to adapt to the changes?
The reality is that most people and most entrepreneurs, I'd say a vast majority, are honest, run their companies ethically, and run it the right way. Unfortunately, always going to have a few bad eggs in life. And therefore, I believe that there'll be more DD before people invest in companies. And that's the reality of life. We have to do that because for that 1% or 0.2% of entrepreneurs who have unfortunately soiled the name of entrepreneurship, and there are lots of examples in the last 2-3 weeks itself. I won't mention names. Everyone knows what companies are talking about. It is reality that more diligence will be done, and our investors expect that of us. We're already doing enough, but more will have to be done. But it is reality of life. We have no choice.
All right, and while we are already cautious, Gopal, are you anticipating any more risk factors and challenges going forward? Very quickly.
I don't think COVID is out of the system. I think I worry about accidents. Last 3, 4, 5 years, large public market investors have, on the back of cheap capital, loaded up on private assets. So I worry about accidents. I worry about,
Yes.
and this could unsettle markets, again, make price discovery difficult, erode value.
Right. All right. So probably the spate of bad news is not over, but then there is a lot of consensus on concept of profitability, corporate governance standards, and also the valuation mismatch will probably find a certain level in the due course of time. Sasha Mirchandani and Gopal Jain, thank you so much for giving your deep insights on how the trend is emerging in this startup ecosystem. Thanks so much for tuning in to all our viewers.